Mark Collinsworth with us again today of Vere Global. And Mark, another very volatile week on Wall Street. Where do we stand?
Well, like we've kind of discussed, we're kind of in that bottoming phase process. This might actually surprise you, but the stock market for the week, the Dow Jones actually finished up the week about 1.8%, and the S&P finished the week up about 0.8%. Even though we had the Dow Jones had about a round trip of about 5,000 points, it was a very volatile week. And what I find really interesting, as we discussed on the bottoming process, I've actually had some people call me this week, even though they're making money from the positions we bought last Friday, they're saying, I just can't take these swings in the market. And you can see that emotional roller coaster now starting to wear on, which is like the phase two of the bottoming process.
And do you expect this to continue and even intensify next week when the markets open on Monday?
Correct. Usually when the market goes into its bottoming phases, it's normally about a 6 to 8 week process where you see ups and downs and people just cannot handle it anymore and they throw the towel in. What I also find interesting from this week is your online brokerage firms like Interactive Brokers. They actually saw huge amounts of new applications coming in for accounts to people to open up to start trading stocks. So you have people now starting to see this as a buying opportunity or viewing this as a casino opportunity. And these people get in the market that should have never probably traded stocks, and they help move the market up and down. And so it's just a matter of time before that emotional roller coaster kicks them out of the market too. And that's usually when the real bottoms occur.
Well, considering all these variables now and considering the apparent increase of the spread of coronavirus around the globe and in the U.S., how is this going to shake out next week and the week after that?
Well, based on history, markets don't bottom really quick. It's usually historically it takes about a 6 to 8 week bottoming process, and during that 6 to 8 weeks, you normally see about roughly a 14% decline from the top to the low. Right now, we've only lost about 12.5% from the top to the low, so we could fall another 1.5 to 2% lower than where we're at now, and still be well within the historical norms.
But Mark, if the panic continues to grow and spread not just globally, but here in the U.S., can't that make it much less, extend the recovery period a lot more and perhaps really head into some dark passages for a prolonged period of time if the panic grows as the spread of the coronavirus grows?
Correct. Wall Street right now is pricing in the worst case scenario right now, which would be a recession. But we may not get a recession. If you look at unemployment data that came out this morning, the unemployment report was just absolutely fantastic, but it had no effect on the market because everyone's looking at how many people will be affected with the coronavirus in the next 2, 6, 5 weeks out.
Yeah, people having to stay home from work and the supply trains drying up and people just staying inside. So, I mean, that sounds like a pretty bleak situation. Is it not so bleak?
The public and Wall Street tends to overreact a lot of times, and your best buying opportunities are when it actually gets to its bleakest. If you look back at January of 2009, that was a stellar time to actually buy stocks. But if you turned on the TV, all you heard about was the next Great Depression. We're in the next Great Depression, but it was a good buying time. So bleakness sometimes actually opens up opportunities.
So you don't see a severe recession or a depression coming?
Not at this point. Usually there's some telltale signs that develop prior to a recession occurring, and right now we don't see that. Economic data has actually gotten stronger with unemployment, ISM numbers, and not to mention the Fed made an emergency 50 basis point rate cut this week to help offset some of the panic in the markets.
Right, but what if this shutdown increases across the country? You know, people not shopping, not venturing out very far, people staying home from work, places of work being shut down. I mean, if this increases, are you really so optimistic? What happens then?
If we get into something that's like really, really just tremendously bad, where it just spreads all across and people do stay at home for an extended period of time, yes, it could. But even then, the coronavirus is only going to stay around for so long. There's over 80 companies right now that are actually working on vaccines to cure it. So I think, it's not cured yet, but I definitely think by, this time next year, you won't hear anything about the coronavirus. And
But if it continues until next year at this time, that's 12 months of some pretty severe curtailments of normal economic activity. Would it not be that?
It could be, but right now we don't see any signs of that. If if signs of a recession start to develop, you'll be one of the first people to know. But as right now, saying that things are going to get bad, there's just no signs of things getting bad right now.
Yeah. Well, now also with the Fed cutting the rates, they cut it by what, half a percentage
0.5%.
earlier this week, and there is more ahead, you're saying? You think?
Correct. Usually, when the Fed makes an emergency rate cut, there's usually more rate cuts to come down the road. I disagree with the Fed making the emergency rate cut. I think they should have just waited till the March meeting. And the reason why is because by doing the cut, they panic people because
Yeah.
essentially what they said with making a 50 basis point cut, you put us in the same boat as Lehman Brothers going bankrupt and 9/11. I don't think the coronavirus is anywhere near that level of a rate cut at this point.
Okay, at its next meeting later this month, how much of a cut do you expect, a further cut?
We're right now looking at the Fed funds futures. They're pricing in about a 75 to 80% chance they'll cut an additional 25 basis points. What I also find really interesting about the Fed funds futures, and the Fed funds futures is a way for people to actually make bets on what the Fed's going to do in the marketplace.
Yeah.
As of right now, the Fed funds futures have a 9% probability of the Fed funds rate going to a negative interest rate policy by this time next year.
Well, that was my next question. Now, there's not that much room to cut rates further. So, what effect does that have? I mean, where do you go from here? To zero interest rates?
Well, theoretically, they can actually go to a negative interest rate policy like we see right now in Europe in some places.
How does that work, Mark, for the uninitiated? I mean, yeah, who would invest in anything or keep money in the bank if you're losing money, if it's a zero interest rate? How does that work?
Well, with a negative interest rate, like right now, you put money in a government bond, the government pays you interest for you loaning the money to them. If you go to a negative interest rate policy, you give the government money and you pay them money to hold it for you.
So,
It's a
what's
great deal for the government.
so what's an investor to do then? That's not obviously a way to make any money. So, how do you make money if interest rates go negative?
Well, if interest rate go negative, really the theory behind it's what's called the wealth effect is that if you don't want to pay, the government interest, it usually forces you into other investments, maybe like stocks or something, to help boost up the economy through investment, if that kind of makes sense.
So, bonds would take a hit then, but stocks would do well.
Well, if you go to a negative interest rate policy, bonds will actually go through the roof because the bonds that are out there that are still paying interest, those bonds will become extremely valuable.
Right, right. The ones that are already out there.
Yep.
But now also there are some concerns about the prescription drug situation, since I guess 40% of our prescription drugs come from India and many from China. So,
Correct.
yeah, that sounds like a pretty alarming situation.
Well, it's actually even more alarming. There was actually, I've actually saw some reports in the past that some medications that come from those countries, we'll call them through backstreet deals, are not even actually medications. There was one case where there was a heart medication that was being shipped over here from China. It's a little yellow pill, and actually, when they did the actual diagnosis on the pill, it actually came back that it was actually the yellow paint they used to paint the middle of roads with.
Well, if we run into that, that also is going to increase and prolong panic, is it not?
That could also, when you start losing confidence in the government, panics get a lot worse.
I mean, I know I keep pushing you about this dire situation, but I'm just considering, all the possibilities. Now, you feel obviously that my kind of talk is really overly alarmist.
Well, I think it's too early to become an alarmist at this point. I mean, like we said, if you look at China, China's actually starting to get their coronavirus situation under control over there,
Right.
which the United States could do it too. What China's doing is they've brought the military in. They've quarantined cities. Some cities you can't leave or enter the city. It's just like if you watch the movie Outbreak or Quarantine, military in there keeping everything extremely strict. I kind of wish the U.S. would do that, but there's some constitutional issues there that prevent us from doing that.
Now, Trump has just signed a $8.3 billion economic relief package. Will that do much to alleviate the situation, and how soon could that have an effect?
That particular bill will not have much of an impact. That bill is more geared towards uh, fast channeling some of those 80 companies that I mentioned. That's going to actually help a lot of those companies go through testing. It's going to actually help fund the CDC to actually bring more manpower in to actually do research on the medications.
Now, also, Mark, reports are that central banks around the world are enacting emergency stimulation packages. So, how is that going to affect the global market and in the U.S. here?
Well, long term, it actually causes kind of a concern. I'll give you an example. One of the more interesting trades to use here over the last several years is to go into the Japanese stock market and go into the Japanese economy, borrow money there at 0%, and then bring it back to the United States and invest it. My concern is that money that's based in Japanese yen has been brought back to the United States and may have possibly have been used to short bonds this week. There's actually rumors going around that some people that actually place that trade, hedge funds, might be on the verge of going bankrupt because what you want to see in that trade is you want to see the Japanese yen get weaker and you want to see treasury bond yields basically lose money. This week, the opposite happened. The Japanese yen got a whole lot stronger and bonds took off like a rocket. So it's a double hit to that strategy.
All right, now also programmed trading has an effect here. Can you explain that to us and what's going on with that now in terms of volatility or stability for the market?
Correct. The program trading is completely run by a computer. Usually, these computer programs are written by guys that have PhDs in mathematics. They don't know anything about actual investing. They're just looking at math formulas. These computer programs will do anywhere between 10,000 to 15,000 trades per second. And the object's not to make a lot of money on the trade, it's to make maybe 2 or 3 cents per trade in profit. So essentially, when you have all these trades being pushed into the marketplace, I'm kind of imagine this. You have a car, which represents the stock market. You have two guys trying to push it, but it's not moving any place. A third guy comes up and starts pushing it, and the car starts to move a little bit. And these program trader guys is the fourth guy that kind of gets a running start and slams their body in the car and really pushes it a lot in one direction.
So the overall effect, negative or positive?
It depends on the situation. I've seen it in the past where program trading, like this week, we had 2 days where the Dow Jones rose over 1,000 points. A lot of that was due to program trading pushing the car in the upward motion, whereas today you saw 1,000 point downslide on the OPL. That's program trading pushing the car in a downward motion.
So overall, let's say for next week or 2 weeks, program trading will result in what?
Well, unfortunately, we don't know how program traders actually position themselves. A lot of them don't hold positions over the weekend. So, like today, we were down almost 1,000 points, and we finished the day down roughly 256 points. A lot of that rally, you saw that 800-point comeback. A lot of that was those program traders not wanting to hold positions over the weekend, just simply closing out of them. And come Monday morning, depending on the news that comes out, those programs will start to either buy or sell on Monday.
Mark, you said in our last session, last Friday, that you see this as a buying opportunity. You still see it that way?
Correct. Just based on history, no, we've gone through the MERS epidemic. The MERS had a 35% mortality rate. SARS had a 10% mortality rate. We even had, let's not forget, Ebola. Ebola, if you catch Ebola, there's a 50% chance you won't survive Ebola. We went through all three of those problems, and the market sold off roughly 13, 14, 15%, and the market came right back.
So, Mark, wrapping it up now, what is your advice to investors? What should they do with their money? Where should they invest? What should they get out of? What should they enter? What's your advice in a nutshell?
Right now, the best advice, and Warren Buffett said this just last week, if you're going to sell stocks, don't sell because of the coronavirus. And I totally agree with that. Don't sell. If there were stocks that you liked before the coronavirus outbreak occurred and they're cheaper now, look at buying those stocks. But don't panic. Take your time. Look at things logically, and buy where you see the opportunities occur at.
So, stay pretty much with stocks.
I think stocks are the best game in town. If you go with bonds right now, if you buy a 10-year treasury bond, you're going to get 0.7% over the next 10 years. If you go and buy something like, let's say, a Philip Morris stock, Apple stock, those stocks have 2% or higher dividend yields. You're going to make a lot more just in the dividend than you would in a 10-year treasury bond.
There are a number of analysts that say that gold is going to be increasing in value, and a good investment is gold. What do you think?
I think gold is a fantastic investment. For the main reason is because now the Fed is cutting interest rates. Up until this week, the government, or actually still even today, the U.S. had one of the highest bond interest rates in the world. So a lot of people from foreign countries was buying U.S. Treasury bonds. And to do that, you have to buy the U.S. dollar, which was pushing the dollar up. Now that interest rates have come down so much, the dollar has gotten a lot weaker. And when you have a weaker dollar, historically, gold goes up a lot.
Mark Collinsworth of Vere Global, thanks very much for being with us once again as the stock market continues to be very volatile as you continue to provide some reassurances. Thanks, Mark.
All right. Thank you.